Hello everyone, welcome to another Hot Forex webinar. This time is presented by Andrea, it's me. Uh, I think if all of you have been to a webinar that I have presented the past 2 years, 3 years actually now. So hopefully you will enjoy this one as well because it's a brand new webinar. And I actually for me it's quite interesting because it's based on historical data, it's based on probabilities. So you will have an idea on how you could how you could respond in during December and January stock markets performance. So it's something that you should know, that nothing is like fluctuating randomly or unpredictably. Okay. um, you could say that some stock markets are actually fluctuating randomly and unpredictably, but others are not. So having this in mind, and by reading and learning which stock markets are not fluctuating randomly, this will help you, of course, with your trading during the end of the year and at the start of the year. Remember, the start of the year significantly, it gives 33 out of 39 times it gives us an indication. So that's nearly 86%, if I'm not wrong, if I remember correctly. It gives us an indication for the rest of the year. Okay, January effect, the so-called January effect. So okay, there are not many traders, or at least clients that we have that are trading stocks. But why not, right? We are offering stocks, we are offering commodities, metals, currency pairs, shares. Why not? Why not trading stocks as well? Why are we all, every new trader is like stuck on currency pairs? Why? You could you could trade anything you want, you can profit on anything you want. Why not trading shares and stocks as well? Why just why is everyone stuck on the currency pair? There are a lot of things that we could trade. There are very, very profitable companies that they are doing well, so their shares are doing well as well. There are a lot of stocks with economies with giants economies at the back that are doing perfect. Why not trading stocks as well? So okay, quickly, as usual, let me know regarding any audio or visual issue that you may face. In the meantime, I'll have to highlight over here, for any longer explanations, please send us an email at webinars@forex.com. Unfortunately, this will be a huge webinar. I have 28 slides to present. So I'm not sure whether I will manage to reply to all the questions that you might have. So if I don't manage to, please send us an email at webinars@forex.com. Okay, let me quickly go through the disclaimer. These materials provide us a general market communication for informational purposes only, and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator for future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible or reliable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as Forex and derivatives may not be suitable for all investors, as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. Please read the full disclaimer, warning, the full risk disclosure, sorry. So, admin's out of the way, that's me. And let's quickly see what this webinar is all about. You are free to send me a question or any comment that you want in our question box. I'm here to help anyway. Can you just quickly, someone just can you give me feedback regarding the audio, guys? So until someone give me send me a message regarding audio and the screen as well, I will just quickly briefly say that this webinar is based on Schwartz-David Stocks handbook. So it's a handbook that David Schwartz did based on the historic data from 1936, if I'm not wrong, up to 1996. So 60 years of historical data in order to compose this investigation, in order to compose this book with a lot of conclusion regarding the fluctuations that we are seeing in the stock markets per month. However, I have only focused. Thank you, Tilly. Thank you, Irimak. Tambiri is your name, yeah, should be. So thank you for your feedback. So as I was saying, he created this book. He did all the investigation on the back based on the historic data for 60 years, 6 decades. And it's a very, very interesting book because you can see per month and per week the odds for stocks to rise or fall. So yeah, it's a really, as according to its name, is a really good handbook for stocks. So in this webinar, as I was saying, we're gonna take, for example, we're gonna focus on December and January, since we are we are at the beginning of December, year's end. And I wanted to present this webinar more precisely because I have noticed, and I think that's the case. Stuart was saying me was saying to me the same thing. Every year we are seeing a lot of traders withdraw money or stop trading. Okay. In December, because they have the belief that you know what, it's a quiet month, it's Christmas holidays, it's New Year's holidays, so the markets will be quiet. So I don't there's no point of trading anymore. I should just withdraw or stop my position, close my position, because the markets are quiet. No, today I'm gonna prove to you, or I would try to prove to you that this is wrong. Markets are not quiet. Actually, as you will see soon in this webinar, based on the historical price trends and the many profit enhancing trends contained in this Schwartz-David Stocks handbook, the most profitable, the best performing week and month of the year is December and January. So it's December, January, then we have April, if I'm not wrong, and June. But actually January is one of the strongest, while the fourth week of December is the best week of the whole year. Did anyone knew that before attending to this webinar? You might think that I'm saying some nonsense. No, actually, 5 of the best. Let me just 5 of the best trading days of the year are uh, are during Christmas time and New Year's time. Okay. No, sorry, not the first week of December, the last week of December. Last week. The first the first week of December is weak. Let me show you this graph. I think you see that. 5 of the best trading days for stock markets. Okay, in his handbook, David focus on UK 100, giving us examples of of FTSE and the S&P 500, but in general, I'm referring to the stock markets in general, in the US stock markets, in the UK stock markets, etc., in Tokyo stock market, etc. So 5 of the best positive trading days for stock markets for the entire year, of course, are occurred in December, and all of them are after the December 21st. So December 22nd, December 23rd, 24th, 27th, and 29th. That's why I decided to give this webinar. So I don't agree with people that they're saying that, you know what, December is a quiet month, so I will withdraw or I will close my position. It might be quiet, I mean, from politics or from news because the parliament is closed, everyone is taking holidays, but you cannot say that this is a quiet market. We have some nice, smooth, positive moves, and this is not like this is based on historic data, on percentages, on probabilities. Okay, so December is also called a steady money maker month, while December and January together are the best of the 2-month period of the year. We're gonna see also after having a very an in-depth investigation and reading the December um, performance. We're gonna see also January effect, which is the best month for UK investors and Tokyo investors as well, but also the second best month for Wall Street. However, I'm gonna present another webinar in the first week of January, exclusively on January effect, and but split it into weeks. So we're gonna see how the first week of the January is about to move, how the second week, the third week, and the fourth week, etc. And we're going to see also 3 guiding principles that you must keep in mind. So let's quickly start because it's a huge webinar, as I was saying. So let me start with December, the so-called Santa Claus rally. Okay, so let me just, because I want to have also the handbook in front of me, just to it will help me because there are a lot of things that I should cover. So December, the Santa Claus rally. So historically, as I was saying, December has been the strongest trading month of the year for global stocks, and especially during bull years, and more precisely, especially the third and the fourth week of December. Okay, I will not call weeks. I will say quarters. Is the correct way to say it, because each month has 4 quarters, right? From 1st to 7th, from 8th to from 1st of December to 8th of December, from 9th of December to 15th of December, from 16th of December to 23rd of December, and from 24th of December up to 31st of December. So I will say quarters of the month instead of weeks of the month, okay? Because there are a few months that they have 5 weeks. So the proper way of saying is quarters, okay? I don't want you to be confused. So let's get back. As I was saying, each year the stock market in general, okay, tends to repeat certain seasonality trends. So these seasonal trends affect all of us, like as retail investors, but also institutional investors. So, and also these seasonal trends affect individual stocks, but also the stock market as a whole. So today we're going to try to understand how these trends work and why we need to be aware of these trends. I need to highlight over here that by knowing, by understanding this kind of seasonal trends, you will be able to gain a slight advantage, okay, when it comes to your trading, you are investing, okay. You need to realize that these trends can help you predict with a higher probability some certain outcomes, some certain performance, even though we cannot guarantee anything, okay? There is nothing that or even the indicators, technical indicators, can guarantee to you the future performance of the market. However, by having these trends, these seasonal trends in mind, it gives you an advantage. It gives you higher probability to be right. Okay, that's why I wanted to cover this topic. So. Okay, by saying seasonal trends, I'm referring to either monthly trends, so like we are used to see between 1999 and 1996, so that's nearly 80 years, 8 decades, that the December prices rises, that the stock market rises every December by 59%. So this is what we mean by seasonal trends. Like every December, we tend to see that, or every fourth quarter, third quarter, second quarter of the year, we're seeing that. Every winter, we see that. Every summer, we see that. So seasons. The stock markets are split into seasons, okay? And there are some common seasonal stock market trends that are mainly seen in January. And at the end of the quarter, so I'm referring, of course, in December, and more precisely during Christmas time. Also, we have another 2 seasonable trends seen between May and Halloween, but we are not close to May. We're not close to Halloween. We have left Halloween actually behind us. So let's focus on December. Okay, so stocks in general are receiving a boost, okay, at the end of the year. That's why we have called it Santa Claus rally. So this buying, this positive trend that we're seeing in December, this buying activity, okay, occurs mainly during the holiday season, beginning on Thanksgiving and lasting through the end of December. Okay, so based on the handbook that I mentioned, on the David Scorch stock markets handbook, and based on years of research from other analysts, other economists as well, we have seen that Dow Jones, okay, advances by 80% of the time during the Santa Claus rally period, okay. or if we're taking to example FTSE, okay, FTSE 100, the UK 100, we have seen that is having a boost of around 1.13%. That's 45 points during the Sunday close period. The 80% in rally in Dow Jones that I mentioned earlier, it was based on on um, on a Morgan Stanley JP Morgan analyst that it was cited in 2011 article, okay, on the Money Watch website. But I found it quite interesting. That's why I mentioned it right now. But my webinar, as I mentioned, is mainly focused on the Davis Squarch investigation. Okay, so between this 80 years period, we have seen that December prices rose by 59% of the time. So positive December overall. If we focus on the FTSE, we have around average boost around 45 points. So let's move on. Stocks in general, actually, the 4 best months of the year is, as I mentioned, December, January, April, and August. Okay, but even though the December is the 4th best month after January, after April, and after August, the interesting about December is that it contains 5 out of 10 best positive trading days for stock markets of the entire year. You can see I have over here the year's 10 best days, and you can see that the ones that they are higher in the 5 out of 10 actually are in the last quarter of December. So after all of them are occurring after the December 21st. That's why December is in focus. And that's why there are many people calling December a steady money maker month. Okay. However, today we're gonna see also the differences between the 4 different quarters of December. So we're gonna see how we're gonna see that the first quarter of the month is quite weak. The second quarter of the month is also so quite weak, and then we're seeing the boost on the third and fourth quarter of the particular month. Sorry. So, but what is very, very interesting is the fact that the month to follow, and of course I'm referring to January, is the year's best month over the long run. Sorry. So that makes December the beginning of the best 2-month period of the year, as I already mentioned. So based on the historic data, December seems to be a good month for investing in stocks and shares, if of course we are going through a bull market. So I'm gonna see how we could identify bear or bull markets prior, like even 12 months in advance, or 7 months in advance, or 3 months in advance. We're gonna see this in detail in the next few slides. So since 1970, we have seen that equity markets have risen every December except for 7 times. So this is like 41 times out of 47. Okay. So that's nearly 87%, more than 87% of the time. We have seen that equity markets have risen every December. Okay, that's a huge positive probability of equity market rising in December, except from some from 7 from 8 actually times that we have seen a decline in December. An example was the 2018, where we have seen S&P 500, so that was last year, that we have seen S&P 500 going down by nearly 9% during the final month of the year. But after that decline, we're seeing that we had a strong rally in 2019 with S&P 500 going around 24% higher year to date, and Dow Jones was almost 20% high, 20% um, um, higher as well. So despite the disappointment that we are seeing in the final month of 2018, it seems that the market has pieced together a 2019 rally by spiking to record highs S&P 500 and Dow Jones. That was an exception of not the rule, but of the historic data that we have seen since 1970. Okay, just this is something that you should have just a notice that I found interesting. So over here I have a table that includes all the price changes in a percentage wise that we have seen since 1990 up to 1996, so nearly 80 years time. You can see that for all the 8 decades that we are seeing over here, only in all these 8 decades we have a declining December, a declining and the average of December price change being negative only once out of 8 times. Okay, so that it seems that for 7 decades December was a profitable, a positive month for stock markets. The only exception was during this decade, which the average of 10 years drifted the stock markets by less than 1% down. So this is another indication that December is doing well since 1920, and that remains the case so far today, with some small exceptions. And one of those exceptions was 2018. So this is like this table is giving us is actually giving us the message that in general December is constant. Okay, it provides average annual profits in every decade based on this record that I just represented, that I'm using in this slide. So, and even in this in this decade, in this troubled decade, okay, in which we have seen a decline, actually you should know that during this decade the 5 years, the 5 Decembers were up while the other 5 were down, so it was 50-50. Okay, what brought this this overall decline, it was just a single year, the 1931, actually 1931, which we had a sharp fall of over 7% in stocks. So but overall the 5 out of 10 years where the December has seen rising, while the other 5 was seen falling. So, but is again is a year out of other 79 years. Okay, so the probabilities of December being on a rally is like way higher than December declining. Okay, so let's move on. So far in 2019, and actually in January 2019 is the 10th year of the equity market bull run, and actually so far we have seen that last month we have seen that S&P 500, actually I mentioned earlier that so far this year S&P 500 is like 24% up year to date. But if you have a closer look on November's performance, you see that S&P 500 rose by 3.45%, and is also up by nearly 6.8% this quarter. So the the key question is whether this will last in December, by the end of December. So um, we need actually to check for signs, okay, for signs in order for signs that they will give us an indication whether we will have a bull or bear market as we going through December. But before I go into that point, I would like also to say that I would like to see together. I would like to present some of the reasons why December tends to be a good month. Is we are usually seeing strong performance in December, for like more than 8 decades now. So one of the reasons that December is quite strong is the um, is is the low probability that a bear market will be in progress as the year draws to a close. So I have put a table over here. Let me just to point. So you see a table over here, okay, that we have the December performance for uh, between between 1919 up to 1996. So you can see over here, this is the first sorry, this is since 1970 up to 1996. So you can see in this table over here that the odds for that the odds are quite low, the probabilities are quite low that the stock market will be engulfed in a bear market by the year's end. So December has participated in a bear market just 3 times. What you can see over here, this 3 over here, you can see what this table is saying to us is that the December has participated in a bear market just 3 times since 1970. Okay, that's much less than most of the other months. Okay, it's actually you can see that July it has participated a lot of times in a bear market since 97. May the same, September as well, August as well. But the least, the month that has participated much less in compared to the other months into a bear market was December. Okay, so traditionally bear markets can be seen in the mid of the year and not in the end of the year. So the chances of seeing a December that has entered into a bear market are very low, are below average actually. If we notice a bear market in December, then this suggests relatively small declines, and typically based on the historic data that have been checked since 1990, that's typically around 3 to 3.60% decline. While if December is in a bull market, then if we're about to see a decline during December, it's just around 1.30%. So you can see here, for 80 years, the average price change in rising years, it was nearly 3.5%, while in declining years it was just 1.30%. Okay, but again, um, again, there are 63% probabilities for the price to rise during December. That's above our average. It's a huge percentage, suggesting that um, um, the performance during December is mainly on the positive side. Okay, so of course during December we might see some small drops, but uh, but these are tend to be limited. Okay, when the prices are falling into a bull market December, their size is quite small. It's lower than average for sure. So the typical December bull market um, tends to decline is in just 1.30%. That's the typical decline that we might see in an overall bullish December. Okay, um, so let's move on. So how we could actually spot whether we are in a bull or a bear market in December. Okay, I need to highlight at this point that you need to have in mind that okay, all these figures that I'm using, all this data that I'm using based on the handbook, is they they cannot really tell you when the bull market will end, but they can actually give you an indication. Okay, we have not identified, and analyst economists cannot identify a trend that will strongly be associated with December bear market yet, but they can of course give us strong indications and give us give us a strong indication on um, how we could continue as we're going through December or at the start of the year, I mean in January. So they are given some indications. So we can see those kind of signals, those kind of indications, like if we check the declines or the rises in November, or if we actually also seeing the performance for the previous 12 months, 2 months, 3 months, etc. So let's take it step by step. um, Okay, I will after we make an assumption that the factors affecting the market are the same. I'm not sure. I don't understand what you just asked, Dodi. Are we making an assumption that the factors affecting the markets are the same? No, there are of course some risks, and I will highlight by the end of December. I have as a last slide in December's slides. I have the risks that we have for December 2019 that you should have in mind. Of course, fundamentals of my could make or break the markets rally. Okay, so all these are the risks that we may face this month. Okay, as we have as we are going as we are going into the end of the year. So, but before I will I will explain that later. Okay, so as I was saying, just to highlight once again that unfortunately we don't have a trend yet, at least, that is strongly associated with December bear market, but we have some trends that have been identified for a bull market signal, starting by a mild November price drop or gain. Okay, so based on the history, but based on this on the last 8 decades, okay, we have identified that typically if November declines by 1.57%, okay, up to a rise by less or equal to 4.86%, that follows a bullish December. Okay, it's not okay. You cannot memorize all these. I can understand that, but it's just some notes that that we have identified during the in this handbook, in this 80 years investigation. So based on this investigation, typically if November declines by at least by the maximum 1.57%, or rise by the less or equal to 4.86%, a bullish December follows. Cautions should be kept when the November's decline is more than 1.72%. If you have a decline in November that is more than 1.72%, then this is associated with a bear market more than half of the time. Okay, this is not a conclusive evidence, but um, but we have seen that if we had a November that it had more than 1.72% fall, then the most of the 50% of the time, the half of the time, we had a bear market in December. Okay, that's the odds that we have observed the last up to 1996. Okay, from 1990. So overall, December story is a good one. Okay, but there are some several historical price trends, okay, that could help us to improve our possibilities, our odds for making good investments, profitable investments sometimes during December. So let's start, okay, let's start with this one, which is okay, let's actually, the first thing that you need to do is split December into 4 quarters. Okay, typically, just to highlight here that the first week of the first quarter of December is quite weak. We are seeing some losses typically in the first quarter of some weakness in the first quarter of December. So that's from 1st of December up to 7th of December. Okay, so it says typically, traditionally, this is this is actually even the first half of December is weak. So the first and the second quarter of December are tend to be we are tend to see a frequent losses. Okay, in the beginning of December, while the third and the fourth are usually profitable ones. So after the mid of December up to January, as I already mentioned, are one of the most profitable periods that we have seen in the entire year. Okay, so you see the odds for price to rise in December, in the first week or in the first quarter of December, is just 40%. That's quite that's very low, actually. It's even lower than the average. So the trend is steadily improved. As you can see in this figure, you can see that the trend is steadily improves as the month progresses. So the final quarter of the year in the final quarter of the year, we have 81% possibilities, odds, for the price to rise. So the final quarter of the year rises 81% of the time, the year's best record. Okay. Also, the third quarter is quite good with 76% odds for the price to rise. So the weakness is mainly on the first half of the December. Okay. This actually, okay, let's move on. So here I have put down some historical price trends for December. Okay, that's since 1922, and this is regarding the FTSE mainly, and actually the predecessor of FTSE. Okay, so this is based on investigation. Since this is based on historic data that I have been seen since 1922. So during this for 22 years, I mean since 1922, we have seen that um, that the share prices were on a rally. Okay, um, in the previous 12 months, okay, by at least 8.74%, while in the previous 2 months, so that means November and October, okay, so we have seen we have seen the shares, the stock market rising within this range, within 0.96% up to 7.94%. So so for 21 years, okay, we have seen December prices rising 21 out of 22 years. Okay, so for 22 years, we have seen that the previous 12 months, in the previous 12 months, the prices were rising at least by 8.74%, with the 2 previous months rising within this range. Okay, so with these percentages, with these price changes, 21 out of 22 years, we had a December that it was in a rally, it was bullish. We had only a single year that December was bearish, that the prices were falling. Okay, and actually that was around December 1941, and it was mainly affected by 1941, and that was mainly affected by Britain's declaration of war on Japan on the 8th of December, and the attacks and the surprise attacks from Japan. So that was due to war, let's say. Okay, so a good indication, what I'm trying to say, okay, in simple terms, what I'm trying to say is that based on the history, if you're seeing a rally in the previous 12 months in the stock markets by at least 8.7%, okay, and also if the previous 2 months, I mean October, November, you are seeing a rally within this range, within 1 to 8%, then you should expect a good December, a bullish December to follow. Okay. Okay. Based on another investigation, okay. Um, sorry for that. Based on another investigation, that was I think again this investigation was based again in since 1922, but it was only, it focused only on 16 years of this since 1922. We have seen that a change in the previous 3 months between a decline of up to 1.74% up to a rise of 5.96% in the previous 3 months. So that means September, October, November. If we haven't seen a price range in the stock markets within this range, okay, can you see hopefully you can see my pen. We're seeing a change within this range, either a decline, the maximum decline up to 1.74%, or the maximum rise up to 5.96% for the previous 3 months, combined with a rise in November, minimum rise of 0.61%, up to 5.58% rise in November, then again we could see a December, a bullish December to follow. Okay. Sorry. So um, if we combine these two investigations, okay, and we eliminate the duplications, because both of the investigations started in 1922 and the one is for 22 years and the other one for 16 years. If we eliminate this duplication, we'll see that that 28 Decembers, okay, we end up with a 29 years period. So 28 out of 29 Decembers, 28 out of 29 years, December was rising. December was in a bull market, while just 1 out of 29 years it was down. Okay, so that's nearly, let me do the months, 96% rally in December based solely on these two investigations. So, okay. So you can understand that the odds, all these investigations are showing that the odds are on the bullish side for December, on a bullish outlook for December. Okay, so that over here, okay. So these historical price trends will help you actually to improve your odds for identifying a bullish December. Okay, another one that I have included over here. It was an investigation since 1958 in which we have noticed a rise in November between 1.75% the minimum rise up to 6.25% the maximum rise in November. So that give us a 10 out of 11 times a bullish December. Okay, 10 out of 11 times, 10 out of 11 times the December was in a rally, with November being with November posting a rally with them at the minimum level 1.74% and a maximum at 6% change. So let's see the flip side. So how you could improve odds for identifying bearish December, again based on the historical price trends for December. Okay, so that should be over here. Sorry. So a bearish December. Since 1933, if I'm not wrong, yeah, we had December's record after a rise in October, November. We have a bearish December 17 out of 20 times. So, okay, this is not a, this is actually, this is an indication that that you might see a decline in December if, of course, October and November have posted a rise of the minimum 0.90% up to the maximum 14.51%. So based on the investigation since 1933, again on the FT non-financial index, solely on the FT non-financial index, we have seen that every time that October or November posted a rally, the minimum 0.90%, the maximum 14.51%, then a bearish December followed for 17 out of 20 times. Okay. Also, another signal actually, which is a signal based on the previous 7 months, so prior 7 months signal. If we're seeing prices being weak by 1 up to 6.71%. So they have posted a decline between 1 to 106 up to 6.71% decline the previous 7 months. So there is a reasonably a high likelihood that that the stock market will also fall in December. So since 1931, there have been 11 declines on the FTSE, more precisely, okay, between May up to November, we for this particular range, okay. So for 11, we have seen 11 declines. So sorry, 9 declines out of 11. Um, 9 out of 11 declines in December, if that December was followed by this decline in the previous 7 months, so between May to November. Is that clear, guys? Are you consider? Yes, holidays is the last quarter of December. So the last quarter of December is 23rd up to 31st of December. Okay. So yeah, what I was saying. So stock markets fell further for 9 out of 11 Decembers of those years. That we have identified a decline up to within this range in the previous 7 months. Okay, this is a lot of wording, a lot of percentages, a lot of historical price trends, so you might take a screenshot or just see again the recording of this webinar, like after we are we reach the after we send you an email with the recording. So also that's the last is a prior 6 month signal. So here is a I have put a useful downside indicator based solely on the price um, of the trend for FTSE over the past 6 months. That was an investigation done since 1946. So since 1948, sorry, since 1948, there have been 10 occasions when the price shifted moderately in the preceding 6 months uh, by a decline of 2.90% up to a rally of the maximum 1.26%. So in the previous 6 months, if we had a change within this range, then that should suggest a bearish December. So that actually, back then we have seen the December prices falling in 9 out of 10 of those years. Okay, so that's between 1948 up to 1958. Okay, that's an investigation between 19 to 48 up to 1958. So Okay, that was based on the historical price trends that you may see, and you need to have in mind, to keep in mind. Okay, so however, let's see how the prices tend to move um, into these 4 quarters of December. So in the first quarter of December, as I already mentioned, um, we can identify weakness. Okay, so price rises just 40% of the time during um, the first quarter of December. The first quarter of December, that's between 1st up to 8th of December, is the worst performer, the second worst quarter of the year, of the entire year. So you can understand that the chances of a price rise in this quarter are very, very low. Actually, they are below average. Even if we are in a bull market, even if we're in a bear market, the chance of a price rise in the first 8 days of December, the first quarter of December, are very, very low. Okay, so I know it's quite funny because I'm saying that December tends to be the most profitable month of the year, but actually this is the case based on the historical data. The first 8 days, the first quarter of December, the first quarter of the most profitable month of the year is weak. Okay, so the beginning of December is weak, as I already mentioned. Um, and the worst day of the quarter is the 4th of December. Okay, this is the worst day for the first quarter of December. Okay, there are only 39% probabilities of the time of the price to rise that particular day. Okay. Um, um, yeah. So in the first screenshot, we have December split into 4 quarters. First quarter, second quarter, third quarter, fourth quarter. So you can see that based on the period between 1935 up to 1996, we have identified only 40% of the time that the price had rise. So you can see that there is a negative annual average every decade except from 1950s and 1970s. But overall, the percentage are to the downside. So as we're going through December, the possibilities of a price rally are increasing, with the peak being at the end of December, between 24th to 31st of December. So for people that they're actually interested on the investing even in the first um, in the first quarter of December, the only thing that I can say is to act fast if you want to invest in the first quarter of December, because the year-end rally will likely to start soon. Okay, so it's you need to be cautious. You need to be very, very careful if you wish to trade the first week of December. Okay, based on, of course, on these poor overall records that we have seen throughout the years, with the notable exception, as I mentioned, the 4th of December, which is the worst day of the particular quarter. So if you are thinking of investing during the first quarter of December, there is only one word: be very careful, be cautious. Be prepared to move fast, because based on the history, in the as we're going through December, as we get in, as we enter the second quarter, the third quarter, and the fourth quarter, um, um, uh, the year end rally is likely to begin soon. Okay, so let's move on. So okay, let's move on to what else did I wanted to also something else other than the 4th of December, which is the worst day. Something also that I wanted to mention is that the odds of price rise, okay, in the first quarter of December are quite low for the most of the weekdays, but with the only exception on Friday. Okay, here it is. Just turn your attention into this figure that I have over here. So the price tends to rise, okay, at a below average rate on most of the other weekdays, with Monday having the worst. You can see that Monday has the worst record of all, but Friday actually um, Friday we have better chances, better possibilities for a price rise. Okay, that's just something that you should have in mind. So Friday is quite good in the first quarter of December. Let's move on to the second quarter of December. Okay, so again, it's quite weak. We have seen that the second quarter of December has risen less than the rest of the next the rest of the December. So it's again a quite weak quarter. The second quarter of December is between 9th up to 80th of December. Okay, caution should be caution required in this quarter as well, because again the possibilities for a price rise are quite low. It's just 56% odds that we will see a price rise, again based on this empirical data between 1935 and up to 1996. Okay, with some with the only exceptions being between 1970 up to 1996, which again we didn't really see a, 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 we didn't really see a big rally, but we had like the odds fell to 50-50 for the price to change. So there was a bit of an unchanged movement, pretty much. Excuse me. So, so again, weakness for we have seen weakness in general, with the only exception in 1970, which price rose up to 66% of the time, while the odds of price rises have slipped to less than 50% since 1970. So in general, a weak bull or bear market. Like sometimes, the most of the times was unchanged. So the percentage were 50%. You see, over here we have numbers of years in which the price rose or fell, and we have 6 up and 6 down. So that's 50-50. Okay, there are 50% chances for the price to rise and 50% of the price to fall. So nothing really that will help us, that will give us an indication. Okay, that's why the only thing that I would mention before entering the third quarter, which is a key one along with the fourth quarter, is that the 9th of December, along with 10th and actually the first 3 days of the second quarter, 9th, 10th, and 11th of December, are 3 of the worst days of this quarter. The price has only 36 probability to rise, either in a bull or a bear market. While the 10th and 11th are also quite dangerous days for trading. Okay, a good day is in the 30th. Okay, with reference back in 1984, sorry, which we have seen 8 out of 9 attempts to the upside. Okay, for particular for 14th of December. Okay, just things that you could have in mind, but in general, it's not a good quarter. So the only record that we have that is quite good for the remaining of the days, other than 9, 10, and 11, is the 30th of December, in which we didn't have any signs of weakness. And we had 13 December's rising. We had 8 December's rising, and 8 out of 9 December's rising since 1984. That was the only sign that was the only thing that we observed at that particular decade. Okay, so let's move on to a more fancy stuff in the 3rd and 4th quarter of December. So even though we have seen that first and second quarter are weak, so the profit odds for during this time are quite weak. The 3rd and the 4th quarter are the best and the very profitable quarters of December in general of the year. So we have seen that price rises in 3 out of 4 years. So that's nearly 75% chances of a rally in the 3rd quarter. Okay, so we have some good trading conditions usually during the 3rd quarter of December, and actually the good trading condition continue until the end of January. Okay, so I need to highlight over here that we have the 2 out of the 5 best days of the year are included in this quarter. Is the 22nd and 23rd of December are 2 of the best days of the whole year. Okay, in which we can see that price tends to rise around 70 to 75% of the time. Okay. Again, based on investigation between 1935 and 1996, we have seen that there is a 76% chance for the 3rd quarter of December to rise. Okay, that's while even in the worst ever decade, which is back in 1960. We have seen that during this decade, that the overall was down by 0.85%. Is something that I showed you earlier. You can see that where was it? 90. No, didn't I? Yeah, here we had. You see, this decade in which we had a negative average in the 3rd quarter of December. Even at that particular decade, which was the worst, we have seen that the 3rd quarter of December had 6 years up, 6 Decembers up, and 4 Decembers down. So between 1960 up to 1969. For 6 out of 10 years, the third quarter of December was up, while 4 out of 10 years, the third quarter of December was down, despite the fact that it was one of the worst ever decades in the stock markets. Okay. Yeah, so two of the best trading days is on the 22nd of December and 23rd of December, which have the 70 to 75%, which we have seen a rise by 70 up to 75% of the time. Let's move on to the most interesting quarter of the month, and of course I'm referring to the fourth quarter of the month. Okay, that's this quarter includes 3 out of 10 best days of the year. Okay. Historically, this is the best quarter of the year in general. So we have seen unbelievably 81% of the prices to percent of the time prices to rally in this last quarter of December, in this last few days of the whole years. And more precisely, we have we have high possibilities, odds for a price to rise on the 24th, 27th, and 29th of December. So that's 2 days. That's a day before Christmas, a day after Christmas, and a day before New Year's Eve. So 3 trading days before Christmas and trading days between Christmas and New Year's. 24, 27, 29, the 3 of the most profitable days of the year. The only exception that we have seen throughout the years, okay, it was between 1969 and 1979, so this decade over here, in which actually it was the only exception, and that was, if I'm not wrong, okay, the only exception that we have seen was during this period in which we have seen the last quarter of December to decline in a bit, but not significantly. So the first preview, the 4 previous quarters, so that means the 3 quarters, the first 3 quarters of December and the last quarter of November changed by 0.3% to 2.74%. Okay, and then we have seen the fourth quarter of December falling 5 times and rising 5 times. So that cannot be a rule, that cannot be an indication, but it's something that we observed in this decade out of 8 decades. So in this particular decade, we have seen that we have seen a good rally the previous quarters, 4 quarters, and with the last quarter of December falling 5 times out of 10. So that's 50% again chances. In the remaining, however, of the 80 years that followed, okay, the fourth quarter rose every single time. Okay, that's every single time. So chances are up to 81% rally for the last quarter of December. Okay, so as Daddy Kimathi asked, are we making an assumption that the factors affecting the markets are the same? So, no, you shouldn't. These are some indications that we could have in mind at the back of our minds, and they could give us some indication of the future performance, in particular in December and January. But Can everyone hear me, or I was talking to myself for the last 2 minutes? I think I did. Can you hear me now, guys? Hello? Anyone? Yes, okay. Sorry for that. I accidentally put myself on mute. So, okay, let's summarize. The risks that you must have in mind for the end of the year is, of course, on the US and China trade front. NFP by the end of the week, this Friday, central banks and general elections by next week. But all these, I think they will be out of our way before the third and the fourth quarter of December. We'll have this out of our ways before Christmas time, before New Year's time. So um, uh, based on the performance of the first and the second quarter of December, with all this out of our way, we'll have a good indication of how the third and the fourth quarter of December could likely perform. Okay, but yeah, this is the main risk that we are facing in December. Okay, actually, it's already we're already 30 minutes after the hour. Yes, of course, that's why we are providing this webinars. Emmanuel will try to help new traders or even advanced traders to improve their trading skills, or to even not only their trading skills, but also their knowledge for the market. So that's where we are here to help. Okay, guys, I'm already 30 minutes after the hour. So I will be quickly fast on the January effect, okay? But don't worry about it, because we're gonna see the January effect in depth in the beginning of January, okay? I think we'll try to schedule a webinar for January effect in the first working week of January. That's the 6th up to 10th of January, between that within that week. So don't worry if don't worry if you don't understand something about January effect, and we're gonna cover it also in a January's webinars. So okay, that's something that I found out in CNBC. So according to a CNBC investigation, and actually in an CNBC article, I have seen that since 1928, stocks are 20% higher, 20% they have risen by 20% or more by Thanksgiving. And that's similar to this year. That's similar to 2019, in which we have seen S&P 500 with more than 24% year-to-date rally. So that's something that has been seen since 1928, that when stocks are up by 20% or more by Thanksgiving, like this year, the S&P 500 usually ends the year even higher. Again, that's not the rule, but this is based on empirical data since 1928. This is something that I found in an article, in a very, very interesting article in CNBC. Okay, with these are the best performing sectors and these are the worst. So this explains the average December percentage change since 1995. Okay, so quickly, December effect. I'm currently following the Forex webinars, but I don't know the one to begin with it and what to follow after. So, Emmanuel, I will advise you, since you are new in Forex, to start with our with the webinars that with the basics. So we have some webinars that I think they're called basics in Forex. Is it how we call it? Let me just, if you go into our past webinars website, or even in our YouTube channel, okay, you can see that our webinars are split into categories. So we have beginners, intermediates, and advanced. So I will recommend you to start to go through all the beginners webinars. There are some basics in Forex industry. Don't remember don't remember how let me just I will try to quickly no I don't remember right now the exact name, but they for sure they are split into categories, so try to go through the beginners ones, okay, to have a better understanding on the basics of Forex industry. um, what's best Forex to trade historic um Irimanga, what's best Forex to trade historically during December and January? This is solely, this webinar was solely on stock markets, okay? Stock markets. No currency market, no metal market, no commodity market. It's solely, these empirical data, these historical price trends that we have seen are solely on stock markets, okay? And this empirical data, this investigation from Score to David was mainly on FTSE, S&P 500, Dow, so US and UK stock market. So there's has nothing to do with commodities, because you mentioned gold declines. Has nothing to do with currency pairs. This was solely a stock markets in December and January. Okay. Okay. So okay, let me go through quickly to January effect, and I will try to cover January effect in depth in the first week of January. So January 2020. So just to have in mind, guys, briefly, that January effect, what we call January effect, is the seasonal increase that we are seeing during the month of January in stock prices. Okay, stock prices. That okay, Akemu. Akemu Tambiri is just solely on stocks. This webinar was solely on stocks, not gold. Okay, so yeah, the January effect is what we call is the concept, is the seasonal tendency that stocks rise in that particular month, in the first month of the year. And actually uh, January give us a good indication of the year's trend as well. Okay, so um and actually um, um, is the best month of the year in London, Tokyo, and the second best in Wall Street. So some of the reasons why we are seeing a rally, an increase in January, is because people and investors tend to sell at the end of December. Some people are saying that they can claim tax losses and they want to purchase the stocks at a discount, but actually the, the tax issue is not it might not be relevant anymore, because now we have people using tax sheltered retirement plans, so the January effect is less important as of 2018. There are some analysts that actually consider that this is the case, but we that hasn't been proven yet. So okay, a reason so far that why we are seeing uh, January being in a rally, it was the fact that investors were like selling their losing stocks at the end of December, and then in order to claim their tax losses, and the purchasing in the but in the the last quarter of December and during January, there are stocks at a lower price, so that gives a new demand and creates a new buying pressure in the stock market, which actually affects gains and losses, of course. Another possible explanation is that investors are using year-end cash bonus to purchase their investments in the following month. So that's why January is quite is the best performing month of the year. And also we have also another reason, a psychological reason. It has to do with the investor psychology. So it's like the year's end, any kind of sell-off that we might identify at the end of the year attracts buyers' interest. Okay, that's something that could explain also the rally that we are seeing since January. So the sell-off in the end of the year attacks buyers. Also, there is also the belief from some investors that it is the best month of the year, so let's start investing. Let's begin an investment program. Okay, that's some of the possible explanations why we are seeing a rally in January. But okay, we cannot really rely on that. But for sure, based on the empirical data, January is the best performance, the best month of the year, with a very high likelihood of the price rising in January. Actually, we have seen 76% likelihood of the price to rise in January. Is the number one best performance month of the year. So that's why I'm saying that is a kind of a barometer for the year ahead. So it could help a lot of investors, it could help a lot of market participants to predict how the market will tend to perform through the rest of the year. Okay, so the January effect takes place from the last trading day in December throughout the first 5 trading days in January. As we have seen, based on the empirical data, we've seen 76% of the time price rising. That was based on the UK investors, while on the US stock markets, we have seen that between 1926 up to last year, we have seen a 62%. We have seen S&P 500 rising 62% of the time, so that's 56 times out of 91. While between 1970 to 2006, S&P has been seen rising 86% of the time for S&P 500. That's are definitely great probabilities that we could have in our site. Okay. Okay, guys, unfortunately, I cannot go through the rest of the slides that I prepared for you. But as I mentioned, we have already covered the crucial December Santa Claus rally. So regarding January effect, we're gonna have another webinar in the first week of January, having a closer look on the January effect and how January tends to perform per quarters. Again, the fourth quarter of January, second, third, and fourth quarter of January, and how actually when we can say that January effect is triggered or not. Okay, so unfortunately I cannot go through the rest of the slides. I need to close the session. Before closing the session, what I will highlight is that seasonality exists, so you need to have it in mind. You need to include it in your trading strategies. It is not seasonality and all these empirical and historical price trends that we have seen so far today can never be guaranteed, but they can definitely give you an indication, okay, and can definitely they can definitely help you predicting with a higher probability the future outcomes and performance of the stock market. So seasonality is it exists and should be one of the many factors that could affect the stock markets, so they could affect your performance as well. So yeah, that was the end of the session. For any questions, because we don't have time, please send me an email at webinars@hotforex.com or through our social media, Stuart Hot Forex Cowell Messenger or Hot Forex Messenger, or we are in Instagram, LinkedIn, Twitter as well, now in Telegram as well. So feel free to send us a text and we'll try to reply as soon as possible. Okay, guys? So thank you very much for attending. Hope that you enjoy it, and see you again next week. Thank you. Bye bye.